Isaac Newton's first law of motion, published in 1687, states that an object in motion will stay in motion unless acted upon by an external force. 300 years later, researchers discovered that this concept can also be applied to financial markets. In this video, we'll discuss the potential of momentum investing and how investors can utilize it in their portfolios. A momentum investing philosophy is based on a simple theory that stocks that have done well recently will likely continue to do well, and stocks that have done poorly will continue to do poorly. Excluding any external events or catalysts like earnings announcements, acquisitions, or corporate disasters, the stocks should remain in motion. An investor who follows momentum investing will buy stocks that have recently performed well and avoid or sell those that haven't. Effectively, investors will double down on stocks that are outperforming while cutting those that are underperforming. Some investors have a natural instinct to do the opposite, selling stocks after they've had a good run or being tempted to double down on losers in the hopes they will recover. The phrase buy low, sell high is drilled into many investors' heads. Momentum runs in the face of this. It's more like buy high, sell higher. Despite this, it is a proven investment approach with the potential to outperform. In Australia, consider the performance of 200 of the largest companies ranked by momentum scores. The momentum score is calculated by the stock's average rolling 12-month risk-adjusted returns. Each quartile contains 50 stocks which are rebalanced semi-annually. Over the last 13 years, the quartile with the top momentum scores performed the best by a significant margin, whilst the worst performing momentum quartile actually underperformed the broad market. The momentum effect is widely recorded and well documented to the point that it's considered a key driver of investment returns along with value, size, and quality. What accounts for this momentum factor? The explanation may lie in investor behavior. One hypothesis is that investors generally overreact to large movements in the share price of a company, whether it be up or down. As an example, say a company announces a new product and the stock price increases significantly. Investors may continue to buy the stock as a recent announcement and subsequent increase in price is readily available and recallable information. Compare this to a scenario where the stock's price only moved a small amount. Investors might not be able to recall the positive announcement as easily, as the price movement was not as memorable. The result is that investors will act by buying into stocks that have risen significantly, fueling the momentum trade. Another hypothesis is that momentum is caused by herd mentality. Investors chasing performance will follow other investors into stocks, and then this herd effect intensifies, driving prices up. Given momentum is a well-established factor with grounding in investor psychology, investors can still include it in their portfolios today. An individual investor or financial advisor seeking to implement a momentum-based strategy themselves faces various challenges, including the time required to manage such a strategy, an unbiased discipline of buying and selling shares, and execution costs. Our recently launched fund, the BetaShares Australian Momentum ETF, ASX code MTUM, provides a professionally managed, cost-effective way to implement momentum investing. MTUM seeks to track an index before fees and expenses comprising a portfolio of Australian companies with above-average momentum scores, as measured by risk-adjusted returns. The index uses a rules-based approach to invest, which helps remove human bias from the investment process. The approach prioritizes consistently strong momentum. Each new company addition can gradually increase its index weight as its momentum continues. Rebalances occur every 2 months, helping the fund achieve a gradual build-up of outperforming companies. Equally, the fund can trim back on holdings with fading momentum and quickly exit the worst performers. Investors can use MTUM as an efficient way of accessing momentum and as a complement to other Australian equity exposures, including both passive and actively managed funds. You can buy MTUM via your broker, advisor, or our investment platform, BetaShares Direct. For more market insights and product updates to help you build wealth over your investment journey, subscribe to the channel.